this is their balance sheet, and for them, for these retailers, inventory is a very important balance sheet position. Yeah, actually here it is their second largest. Have a look at the balance sheet, please. And can you see inventories here? What is inventories? How do they call inventories? How does Hennes and Mauritz call inventories? Where do you see it? Where is it shown here? Picture is not so clear. Okay. Okay. Sorry for that. But you find it under current assets. Yeah, we already said it's short term. Yeah. So it's current assets. It's not. This is here. This is fixed assets. This is long term. Yeah. So it's under short term assets, and it's not. It's here. It's stock. They call it stock in trade. Yeah. Yeah. So this is our inventories, and if you look at the size, it's very big. Actually, it's their second largest balance sheet position. Only this equipment tools is bigger. So stock in trade. This is inventories. Yeah, they call it stock in trade. This is inventories. Is their second biggest balance sheet position. Yeah. So if you think about what does H&M do, they buy inventories. They buy the T-shirts. Yeah, and then it is based here on the shown here on the balance sheet, and it is called stock in trade. And here it is shown. It's stated at cost. Yeah, this is important. Yeah, they have to state it at cost. Yeah, they are not allowed to value it based on the selling price. And it's not allowed. It's not. They are not allowed to say, okay, eventually we will sell our T-shirts for, let's say, 20 euro a piece, and that's why we put it on the balance sheet with 20 euros. Instead, they are only allowed to state the inventory at cost. Yeah, this is how much they have paid for inventory is essentially. Yeah, so they are not allowed to put it based on the selling price. Yeah, so this is the balance sheet here. This is the balance sheet of Hennes and Mauritz. This is the balance sheet, and this is the income statement. Yeah, The balance sheet, of course, shows assets and liabilities of the company. And here we have the income statement with revenues and expenses. Yeah, and the related position in the income statement is called cost of goods sold. Yeah, so you see it here. And this is essentially, this is the largest item here, the largest expense for Hennes and Mauritz. The largest expense item is cost of goods sold. Yeah, and this is it's higher than all the other expense items together. And when Hennes and Mauritz sells the products, the cost of the inventory, they become an expense account. Yeah, and these costs of goods sold, yeah, of course, yeah, this is also based on the cost, based on the cost of the inventory. Based on cost of the inventory. Yeah. Now it's warehouse rent is not cost of goods sold. This is really the costs which are directly related to the product. It depends. It could if the warehouse is directly related to the product, then it could be under cost of goods sold. Yeah, but only if it's really related. If we're talking about the general administrative costs, they are not cost of goods sold because they are here. But if the warehouse belongs directly to the product, yeah, then it could be cost of goods sold. If it is only for this this product, this good, then a warehouse rent could be under cost of goods sold. Yeah. So the sales here, the sales of course are not based on the costs, but the sales are rather based on the selling price. Yeah, the sales are based on the selling price. The cost of goods sold are based on the cost. Yeah, and if you subtract cost of goods sold from sales, you got the gross profit. Yeah, gross profit is sales minus cost of goods sold, and then if you subtract all the other costs, yeah, which are not directly related to the product, yeah, the cost of goods sold are directly related to the product. Those other costs, they are not directly related to the product, and if you subtract all the other costs, then you come to a profit or net profit, net income. Yeah. So this is the bottom line of the income statement here. This is the bottom line. The bottom line. And this is mostly mostly net income. Yeah, it's mostly called net income. Yeah. Okay. Yeah, but the important point here. And the following note, what is note 6 and 8? Yeah, note means those things, those items are explained in the notes. Yeah, the notes are explanatory notes, and they follow after the financial statements. Yeah, so if you want to have more detail, then you can look this up in the notes. Yeah, for example, for selling expense, or here cost of goods sold, look at note 6 and 8, and then you get more. But this is for more detail. Yeah. So notes are always there to explain what is shown in the financial statements. Yeah. Some notes relate to the balance sheet, and other notes relate to the income statement, and they explain the items in more detail, essentially. Yeah. But yeah, on the balance sheet we have it's called stock in trade or inventory. Yeah, when inventory leaves the company, and this is when the selling process happens, then it's called costs. Then the related costs are called costs of goods sold. These are the costs that are directly related to the product, directly related to the inventory. Yeah. Yeah. And here you see, actually you see all the costs that go into inventory and go into cost of goods sold. Yeah. So on the left hand side here, you see the balance sheet. The left hand side, you see the balance sheet. On the right hand side, you see the income statement. Yeah. And whenever the selling process takes place, whenever the selling process takes place, then what is on the balance sheet, yeah, stated as cost, becomes cost of goods sold. Becomes cost of goods sold on the income statement. Yeah, and here you see the ingredients, the different costs that go into inventory. Yeah, so and this is for a manufacturing company. Yeah, so this is for a producing company. For a retailer, it just says merchandise. Here you see it for a manufacturing company, and you see that it's raw materials, the cost of the raw materials. You see labor costs. Yeah, whenever you're producing something. Yeah, this is work in process. The labor costs go into working process or unfinished products. This is unfinished products. Unfinished products. And you also have production overhead. Production overhead also goes into the cost for the product. Yeah. Do you know what what overhead means? What could be production overhead? Okay. This is, for example, if you have energy, yeah, if there's energy which is used only for one machine, for this for the machine that produces one product. Yeah, it could also be depreciation, but depreciation has to be related to this product. Yeah, it has to be related to the production process. It could, by the way, this could also be. You asked about warehouse rent. If the warehouse is only related to one product, yeah, then you could include the warehouse rent. Yeah, then you could include the warehouse rent. But the warehouse has to be related to this product. Yeah, if it's related to several products, then you're not allowed to include the whole warehouse rent. Yeah, but if it's only allowed to, if it's only about this product, yeah, then utilities expenses, yeah, exactly. So this is all production overhead, and that goes into the to the products, yeah. And so here, this is on the balance sheet, and whenever you sell the product, then we are talking about, and it switches and it becomes part of the income statement, yeah. And then it's called costs of goods sold. On the income statement, it's called costs of goods sold, and these are the costs that are directly related to the product. The cost of, you can call it the cost of the inventory. Yeah. So here, the cost of the inventory shifts from asset to expense when the seller delivers the goods to the buyer. Yeah, it shifts from asset to expense. Asset is on the balance sheet. It's on the balance sheet. And expense, that's the income statement. Right, John, you're asking if it not sell out, what would it would become? What do you mean? I don't get it actually. Can you clarify what you mean? What it would become? I'm not. I think I'm not getting it. Anyway, I will go on now, and maybe it will be clarified later. Yeah. So if the inventory stay in the warehouse, then it is still on the balance sheet. Then they do not become part of the income statement. It's still on the balance sheet, and if it is, it might never sell, yeah, and at some point in time they might lose value because no one wants to buy them, and then the company has to write off the inventory, yeah. But this is only when no one buys it. Exactly, yeah, exactly. If first of all, if no one buys it, it doesn't matter, because there in later periods there might be someone who buys them. But if there will be no buyer for longer time, it might be that actually the value of the inventory impairs, and then you have to write. Okay. The cost of the inventory shifts from asset to expense when the seller delivers the good to the buyer. On the balance sheet, yeah, when on the balance sheet, inventory is based on cost, yeah. Yeah. Cost of goods sold is also based on costs, yeah. The sales revenue, in contrast, yeah, when the company books sales revenue, this is based on the selling price, yeah, of course, yeah. So this is based on the selling price, and the accounts receivables are also based on the selling price, of course. Okay. So here you see the journal entries. The first is a company buys inventory. Yeah, so the company buys inventory, and obviously here the company buys inventory on account. Yeah, that's why you have accounts payable. It's not paid with cash, but instead it's paid. It's bought on account. Yeah, so you debit inventory and you credit accounts payable. Yeah, you debit account inventory, you credit accounts payable. So this is an asset. This is an asset, and this is a liability. Yeah. Later, when the company is selling the inventory, yeah, you have two separate journal entry. First of all, this is the first is the journal entry for the sales revenue and the account receivable. Yeah, here you have asset, which is up, and sales revenue affects equity. Yeah, affects equity because it goes into the income statement. Yeah, it goes into the income statement, and this is based on the selling price. Yeah, this is based on the selling price of the product, and here you have another journal entry. You debit cost of goods sold. You debit cost of goods sold. It goes into the income statement, and eventually reduces your equity because it's an expense. It's a cost. It's an expense, and you credit inventory, and when you credit inventory, this is an asset that has to go down. Yeah. So these are the journal entries here, and in this case here you see that actually the gross profit here is 300 euro. Yeah, because sales revenue is 1,300. This is what the company gets for selling the inventory, and this is cost of goods sold is 1,000. Yeah, so the gross profit is 300 in this instance here. Yeah, exactly. Yeah. The accounting records show you the number of inventory units. Yeah, so generally you do your accounting, and in your accounting records you see the number of inventory units, and on top of that there also has to be a physical count. Yeah, so there has to be a physical count, and the question really is, does this match? Yeah, do they match these, the accounting records and the physical count? And if it matches, then everything is fine. If not, then an adjustment has to be made. Yeah, then you have to adjust. If the physical count differs from the accounting records, then you essentially you have to adjust. Yeah, you have to if accounting records do not match the physical count, then an adjustment has to be made rather. What about goods in transit? Yeah. First of all, what is goods in transit? What do we mean by goods in transit? Do you have an idea? Do you have an idea what goods in transit mean? On their way, exactly. Yeah. So it's between the seller and the buyer. Yeah. If you're, let's imagine you are at the balance sheet date and at the 31st of December, and the good is the product is essentially it's between the seller and the buyer, and there are two definitions, and the first is free on board shipping point, and the second is free on board destination. Yeah, so this is the first, free on board shipping point, and the second is free on board destination. And so these are the legal titles of the goods. And free on board shipping point means the ownership passes to the buyer when the public carrier accepts the goods from the seller. When the public carrier accepts, when the public carrier accepts the goods. Free on board destination means the ownership passes. Or the ownership, the ownership remains with the goods, with the seller, until the goods reach the buyer. Yeah. So here it's at a later stage. Yeah. Free on board destination. When the goods reach the destination, when the goods reach the buyer, then the ownership changes. Free on board shipping point. The ownership passes earlier. Yeah. When the public carrier accepts the goods. This is here the goods are not yet at the buyer, but rather they are when the public carrier the ownership passes when the public carrier accepts the goods. Yeah. Next slide, I think, shows it clearly in a picture. Yeah. So here you see it. Yeah. Here you really see the difference. These are the legal titles. You have free on board shipping point and you have free on board destination. Yeah. When you agree on, the buyer and seller agrees on free on board shipping point, then ownership passes here. Yeah, ownership passes here. When is free on board destination, then ownership passes here. Yeah, so that's the difference. Yeah. Here, when does ownership change here? When the carrier, this is the carrier, yeah, the truck here, takes the good from the good from the seller. Yeah. Yeah. And that means, from the perspective of the buyer, yeah, it is free on board only until here, and then the ownership changes. Yeah, and the buyer here, the buyer takes the bears the additional costs and risks. Yeah, and in the second case, yeah, the costs and risks stay with the seller until here, and then ownership changes here. Yeah. So here the ownership passes, ownership changes, then the carrier gives it to the buyer. Yeah, and it's here the buyer has no costs to bear. Yeah. Yeah. And the reason this question is also important is because it determines when the seller can recognize sales revenue, yeah, and cost of goods sold, of course. And on the other side, the answer also dictates when the buyer can record inventory. Yeah. So imagine you have reached the balance sheet date. Balance sheet date is today, and the good is still on its way. The good is with a public carrier. The question is, can the seller already record revenue? Yeah. Can the seller already record revenue? And in this case, yeah, free on board shipping point, when the good is here, yeah, when the good is here, and we have reached the balance sheet date, the seller can record revenue. Yeah. In this case, yeah, the seller is not allowed to book revenue because it's free on board destination and the ownership only passes here. Yeah. By the way, free on board shipping point is more frequent. Yeah, this is the more frequent legal title. Yeah, so most goods are free on board shipping point. Yeah. Does it make sense? Do you understand the difference? Okay. Another thing which is important is inventory costing methods. We have different costing methods. the most important ones is FIFO, LIFO, and weighted average. Yeah, and FIFO means the first inventory costs incurred are the first costs to be assigned to cost of goods sold, and FIFO leaves the last, which is the most recent cost, in the balance sheet. Yeah, you can also write, and this is a rule of thumb, you can write FIFO-lish. Yeah, FIFO-lish. And FIFO-lish stands for, it stands for first in, first out, last in, still here. Yeah, so first in, first out, last in, still here. This is FIFO-lish. Yeah. And then you have another inventory method, which is called last in, first in, out. And you can write LIFO-fish. LIFO-fish. And LIFO-fish stands for last in, first out, last in, first out, first in, still here. Yeah, this is LIFO-fish. Here, the last inventory costs are the first costs to be assigned to cost of goods sold. And LIFO is different than FIFO. LIFO leaves the in the ending inventory the oldest cost incurred. Yeah, here it's the last, most recent. Here it's the oldest. Yeah. And there's the weighted average, which is based on the average cost of the inventory. I think the next slide will make it even more clear what is meant by FIFO or LIFO. These methods, they affect the balance sheet. They affect the value on value of the inventory in the balance sheet. Yeah, value of the inventory on the balance sheet, and the value of cost of goods sold on the income statement. Yeah, and cost of goods sold, of course, influences net income. Yeah, so, and here I think this makes it more clear. Yeah, this slide makes it more clear what is meant by LIFO and FIFO. This is FIFO, first in, first out. Yeah. So, and again, you can write FIFO lish. Yeah, FIFO lish. First in, first out, last in, still here. First in, this is this, yeah. And first in are first out. These are the orange ones. They are first out, and they are first assigned to, that's why they are first assigned to cost of goods sold. And the last in, this is last in, they are still here. Yeah, they are still here. And think about what that means. If you have normal inflationary prices, so rising prices, that means essentially that your costs of goods sold are relatively low. Yeah, because over time your prices are rising. Yeah, over time your prices are rising, and your costs of goods sold are calculated with the low prices at the beginning. Yeah, it means your cost of goods sold are relatively low, and your profit is high. Yeah, and so this affects the income statement, and on your balance sheet you have a higher value because the ending inventory is based on the later purchases, which are more expensive than the earlier one because you have rising prices. So FIFO means in normal times, and normal times are inflationary times, you have higher profit because of lower cost of goods sold and higher value on the balance sheet. Yeah, let's look at, to make it even clear, more clear. Let's look at the opposite: last in, first out. Last in, first out. This is LIFO again. Think about our rule of thumb: LIFO fish. So last in, first out. First in, still here. Last in, these, yeah, are first out. This is the blue one. And the first in, which is the orange one, are still here. Yeah, and still sitting on the balance sheet. So that means in normal, I call it normal inflationary time. If you have deflation, then it's the other way around. But if you have normal inflationary times, then you have lower profit because cost of goods sold are higher. Yeah, so because cost of goods sold are higher because these prices are higher than these prices. Yeah, in normal inflationary time, you have higher cost of goods sold, lower profits, and lower asset values sitting on your balance sheet. Yeah, so this is the result of whether you use first in, first out, or last in, first out. If you do use first in, first out, you have in normal inflationary times higher profit and higher value on the balance sheet. Yeah, so that is why some companies, they prefer first in, first out over last in, first out, if they have the choice, because they want to appear richer and yeah, more wealthy. On the other hand, if companies want to save taxes, then they sometimes prefer last in, first out. Yeah, in US GAAP, they can choose. According to US GAAP, they can choose. According to IFRS, last in, first out is not allowed. Yeah, according to IFRS, last in, first out is not is not allowed. Yeah. And the weighted average is just, as you see here, it's just an average. Yeah. Generally, does that make sense, or are you do you have any questions? Is this clear? Or do you? Okay. Okay. So then we can go on. So here it says in IFRS, cost of inventory shall be assigned by using the first in, first out, or weighted average. Yeah. So first in, first out, or weighted average. Yeah. LIFO is not allowed. LIFO is not allowed here. Yeah. This is different than US GAAP. In US GAAP, LIFO is allowed, but not according to IFRS. Generally, inventories shall be measured at the lower of cost and net realizable value. So here comes the write down into play. Yeah. So when the net realizable value, when it is lower than cost, yeah, and this is essentially when the product loses value, yeah, then a firm has to do a write down. Yeah. And how do you calculate the net realizable value? The net realizable value is the estimated selling price minus costs to complete the product and minus costs necessary to make the sale. Yeah. So if you realize that the selling price will be much lower than you originally thought, you might think about whether a write down is necessary. Yeah. There is one exception, and this is materials and other supplies held for use in the production of inventories are not written down if the finished products in which will be incorporated are expected to be sold at or above cost. Yeah, what that means essentially is that if the firm does not intend to sell the materials but the finished products, yeah, if the firm does not intend to sell the materials but the finished products, then it's not the selling price of the materials which is relevant, but it's the selling price of the finished products. Yeah, you cannot say, okay, my selling price of the materials is low, and that's why I write down my asset. What is relevant is the selling price of the finished product. Yeah. So this is the exception. But generally, you have to write down an asset when the net realizable value is lower than the cost. Yeah, cost is also called book value. That's called the book value. Book value, because that's the value stated at the books, stated on the books. Okay. Are there any questions here? Do you have any questions? Clear? Okay. Then I thank you for your attention. Very good again. Yeah. So you participated well in the lecture, and I hope this keeps going on in the next lecture. So thank you very much for your attention, and see you. I think next week we have a lecture again. This week there is no lecture, but next week we should have a lecture. But I will send you an email again. So thank you, and